But first, Federal Reserve Chairman Jerome Powell appearing earlier today before a Senate Banking Committee in the first of 2 days of semi-annual testimony that goes before both houses of Congress. Now, intermixed with efforts to get Powell to co-sign political ideologies were great discussions on the woes of rural America. Powell began with his typical cautionary stance, saying the economy is healthy but warns of possible cross currents and conflicting signals. But he also made a point of reassuring Wall Street about future rate hikes.
We still see muted inflation pressures, and that gives us the ability to be patient with monetary policy, and that's what we're going to do. This is a good time to be patient and watch and wait and see how the situation evolves.
Joining me now, Efficient Advisors Chief Investment Officer Larry Schober. Carol Roth is back with us as well. Larry, I mean, you're at the CNBC. You get to watch everything in real time. How was the reaction as Powell started to fend off these questions? And toward the very end, I thought was interesting. He's like, listen, hold up. Before anyone leaves the room, I'm playing ball. I'm playing ball. I mean, the markets wore down a lot when he started.
Yeah, you're exactly right. And since then, the response has been muted at best. I mean, I think people are interpreting this whole sermon on patience to be more about being non-reactive. And I think that made people happy. We did see the long end of the curve. Yields are down. But the very front end of the curve, vice versa. So we're seeing what we call flattening of the yield curve ever so slightly. And going forward, that could be meaningful because, like right now, he's in the camp is like we're done unless we don't have to be done. That's what people are taking away from what he said today.
Carol, you're an astute Fed observer. Chairman Powell, October 3rd of last year, made some unfortunate comments that sent the market into a 3-month tailspin, and he's been digging himself out since then. Has he done enough to make right those incorrect statements?
Yeah, he had a rough one out of the gates, and I think that he's been trying to find his way. And I almost thought he painted himself into a little bit of a corner in January, right before we got those great jobs numbers. But he reiterated today the same stance. So it seems like he's really got his footing underneath it. And I have to say, I love the fact that all of the senators, with the exception of Elizabeth Warren, were pretty much adults in the room. And I love the fact that he took them to task over policies like getting more people back into the labor force and giving them the incentives and not spending so much in Congress. So I actually thought he did quite a good job today.
He also took him to task over this notion that deficits don't matter. In other words, they pox on both houses since he was there. You know, Larry, there were some other things that came up. Sherrod Brown tried to back him into a corner, but I think in answering this question about how sluggish wages have been post the recession and how great things are now, wages are growing faster than productivity and inflation. So is that a Goldilocks scenario?
You know, right now it seems to be, because when you think about it, employment figures are at unsustainable levels, and we're not going to be raising rates. It really doesn't make a whole lot of sense where the economy is at a full capacity. And it's not Jerome Powell's fault. It's not the FOMC's fault. It's just really enormous structural changes going on in our economy that we're using old metrics to judge what's going on today. So all that to say, it's really good that one rate hike is left on the table, even though he didn't iterate that today. And with unemployment, I'm not really sure what the whole gist of it was, because unemployment is strong. Wages are starting to creep up.
So, but before I go back to Carol, Larry, initially you suggested something about the yield curve. I mean, if that inverts and signals for some people recession, then what should the Fed do? Should they be raising rates into that environment?
Well, let's be clear. Like, you know, the Fed really looks at the 3-month 10-year more than anything. They don't look at the 5.7 to 2.10. They're really looking at the 3-month 10-year, and that did flatten quite a bit today. But all that to say, like, we're in the midst of a policy experiment we've never attempted before, and for the curve to invert, depending on why it inverts, is really the whole key.
Right.
It's, you know, in the textbooks it'll tell you, yeah, it means recession, but I don't think necessarily so this time. Right. M2, you know, the velocity of money is much different than it was before. It's definitely a warning sign, but not a direct indicator.
Real quick, Carol, I was really happy to hear Chairman Powell suggests that higher wages, particularly amongst low-skilled workers, would not trigger a Fed reaction. People were very afraid of that just 1 year ago when that January jobs report showed a 2.9% increase in wages.
Yeah, I think that's right. And I think that, one, it's a really good thing in general. But you have to remember the way that we calculate wages has somewhat shifted. It used to be these cost of living adjustments that people would get over and over again, and that would sort of cause inflation. Now companies pay more bonuses, so they have more flexibility in terms of managing that wage growth. And I think that factors into the overall inflation equation.